Welcome back, and thank you for staying with us here for Live Impact News. We have to talk about the conflict right now between the U.S. and Iran. Particularly today, we're focusing on the impact on everyday Americans when it comes to the economy. Joining us this morning is a guest that we love to have in, Dr. Bob McNabb, economic expert, professor, Old Dominion University. A lot to talk about this morning. But before we get started, I need to bring in something that just came in, seeing this being reported from ABC News, that the U.S. economy lost 92,000 jobs in February, which nearly erases all of the job gain that we saw coming in the month earlier. There were 130 jobs added the previous month in January. Let's start with this. This just came in within the last hour, looking at this new government data. What do you have to say about that? How should we read into this?
Well, let's take a step back and look at the larger picture. The U.S. economy contracted in terms of jobs by 92,000. So there was some factors that were temporary. For example, bad weather, a Kaiser Permanente strike. More troubling was the revision of the December and January job numbers down by 69,000. So everybody who was saying, look, we had 130,000 jobs added in January, that number was revised down. Also, in February, we lost another 12,000 manufacturing jobs, another 10,000 federal civilian employment jobs. So the broad conclusion is not only did job growth weaken considerably in 2025, it's not going to be as strong in 2026. And we see that here in Hampton Roads in Virginia, where the unemployment rate has crept up, and also more troubling, the labor force participation rate, that is how many people out of the labor force that could work are actually working, dropped. So less people are working, less people are participating, slow growth, higher prices. It's not a good combination.
And now add on to that this conflict that we are experiencing. One of the questions I was going to ask you, looking at when it comes to our economy from a job growth, industries perspective, if this were to keep on, how could it potentially impact industries here in the United States?
Well, the easiest way to think about this is what does the increase in oil prices and then fertilizer prices and aluminum and other things feed into the supply chain in the United States. So just look around you. If we look at your car, it uses gasoline. So we know that gasoline prices have increased, will continue to increase in the short term as instability spreads across the Middle East. We know that fertilizer is an input into agriculture. So you would expect the prices of domestic fertilizer to increase, international fertilizer to increase, so what you pay at the grocery store would eventually increase as well. You look at clothing, textiles. Well, guess what? Polyester, for example, is used with petroleum. So if this continued to go on, we'd see the price of clothing rise. So the real concern that a prolonged conflict with Iran would be very simply that job growth is slowing, and this adds fuel to inflation, which was already rising in the latest data. And that would bring up the perfect storm of stagflation, that for the ordinary American, you would see it harder to get a job and retain a job. At the same time, the money that you have to pay for goods and services is increasing.
And again, having to have that conversation on top of what you just said in response to the latest jobs report can't be the sign that you would like to see to start off here in 2026. I want to ask about, let's talk about gasoline. I mean, you just got into it, and we were just talking about looking at the crude oil prices at the moment. The latest I think we saw was somewhere between 85 and 90 per barrel. How does that translate to impacting everyday Americans in terms of what we're getting at the pump?
So there's the spot oil for crude, which is the on-market price, and then we want to look at futures contracts, which are what people believe is going to happen to the price of crude in the future. And the futures contracts market is up and signaling extreme risk. And that's really tied to Iran's action in the Gulf to really shutter traffic through the Strait of Hormuz. And what does that mean? Well, there's good news and bad news here. The good news is the U.S. is in a much better position than it was 10 years ago with domestic oil production. We rely less on imports from the Middle East. We actually rely now more on oil imports from Canada. So we actually need Canada here to help us with oil imports. The rise in domestic oil production, the rise of imports from Canada means we're more shielded from increases in the global price of oil as a result of the Iran conflict. On the other hand, you have to recognize that many of our trading partners are not. Europe is much more dependent on imports of oil from the Middle East, and so is China. And you have to look around your house and go, well, what do I buy that is produced in Europe or in China? And if the price of oil continues to increase, not only does it cost more to manufacture things, it costs more to transport things. That raises the price of imported goods, which, by the way, are now going to be subject to a 15% tariff. So, again, if we are trying to reduce the rate of inflation, if we're trying to address affordability, what we're seeing right now in 2026 is just a lot of pressure to push prices upward.
You know, I'm so glad that you brought up tariffs, because I was sitting here listening to you and I was thinking about this earlier today, just about the interconnectivity of everything when we're talking about global economics, global policy, and some of the things that we've seen through the administration, the decisions that have been made. And I think you can, in a way, be nearsighted and just be thinking about, okay, the players who are in this particular conflict, who are fighting. But to your point, there are a lot of other factors like tariffs that will come into play that are entered into this conversation when you have to depend on other countries across the world for trade and while you're in war.
Yeah. One thing that probably is not on the top of most people's minds is U.S. treasuries, U.S. government debt. So what we've now heard out of the Hill is that the Department of Defense, Department of War, is going to submit a supplemental request to Congress that may be in the order of $100 billion or more dollars to fund the conflict with Iran, because estimates suggest that the burn rate is approaching $1 billion a day, if not more, for munitions, logistics, supply, troops, etc. We have to remember that the U.S. government is running a deficit already. It's going to be higher than $1.5 trillion a year. It's got to refinance another $8 to $9 trillion of debt. So all these things come together into the U.S. government really having to flood bond markets with a lot of debt in the hopes that people will buy it. And that could lead to a situation where you have slower growth in terms of jobs, higher prices, and people view treasuries as more of a risk. We just don't know, but it's a lot more uncertainty when the federal government is running a huge deficit year after year after year. Now, the average homeowner in Hampton Roads goes, why does it care about me? Well, your mortgage rates are largely determined by the yields on the 10 and the 30-year treasury. And so if those yields go up because people are expecting higher inflation, your mortgages on new homes and refinances are going to go up in terms of interest rates.
Another thing we don't know is how long this conflict is going to last. We've heard the president put out some time frames, maybe 4 weeks or more, but then you hear from Defense Secretary Pete Hegseth, who kind of pushes back and said, we don't have an exact time that we're going to put out there, but we're prepared to do what we need to do. We're setting the tempo. He said a few different things. Obviously, you have those who are in Iran who believe that they can outlast anything. We really, truly don't know how long this is going to be from a communicated standpoint from our government here. Getting back to the everyday cost also that we're experiencing, we talked about gasoline and at the pump. You just hit on mortgages. Are there any other things every day that we could see maybe impacted maybe more than gasoline? We talked about groceries. I would imagine transportation at this time, mind you, we have, DHS is still unfunded and you have those employees there. Are there any other areas that we could see impacted for everyday Americans when they're trying to just live?
Well, you're going to see it appear in the prices of jet fuel, for example. So airlines which have returned mostly the profitability are going to struggle, and those costs are going to be passed on to passengers.
Yeah.
You'll see it in terms of shipping companies that are going to face higher costs as well. And they're already operating on thin margins, so those costs will have to be passed on to consumers as well. So let me give you an example. One of the things that Amazon does is they offer free 2-day shipping for Prime members. If the costs of transportation continue to increase dramatically, that 2-day may go to something longer. You may find certain products are not available in a short window. They've invested heavily in EV technology, but again, at the end of the day, the people who are creating the products and bringing them to Amazon and Amazon is selling, well, they don't have those EV infrastructures as well, so electric vehicles. So it really is an economy that at its core is dependent upon petroleum products. And so crude oil, natural gas, and other byproducts as well. And when things become uncertain, prices tend to rise. And we're not only seeing that at the pump. We saw prices at the pump increase 10, 15 cents per gallon overnight. That will start bleeding into grocery store prices, restaurant prices, clothing prices. And the longer this goes on, it just will push up the general rate of inflation. And then the Federal Reserve is between the rock and a hard place with the weaker job reports and higher prices, and they really are going to probably come down on combating inflation rather than jobs.
I was just about to ask you if we could potentially see any pressure on the Fed with all of this if it were to continue, especially when you think about the backdrop, the pressure that's already been on them over the last year since the president has been in office to lower those interest rates. How you think this all plays into that? I was literally just about to ask you that next.
So, if we look but for the war in Iran, if we ask what was the position of the Fed going into last week, we had significantly weaker job growth in 2025. Today just came out retail sales were underperformed in January. Non-farm payrolls underperformed in February. Right, there was a mounting evidence that while gross domestic product was increasing, that the economy for the average American was doing worse. Right, higher unemployment, slower job growth, and so and moderation of inflation, which was the good news. So it actually was teeing up the Fed to basically cut interest rates in the second half of the year, because the Federal Reserve was like, we need to see more evidence, right? We think the economy is slowing. We think price growth is moderating. We need to shift our focus to job growth and away from price growth. This kind of flips the story on its head, where the Federal Reserve is like, we can't let inflation come back. We can't go back to 2022. And this is cost push inflation. This is costs are rising. They're feeding into the supply chain, and then prices rise. That's much different than demand pull inflation, where people want a lot of stuff, they're bidding up prices, and the Federal Reserve says, hey, we're going to raise interest rates to tamp down demand. No, this is the problem of, all of a sudden we've got this huge surge of cost potentially coming in the system. We don't care as much as jobs. We really got to address that. So you're seeing bond markets react accordingly. They're basically going, well, I don't think this is going to push the Fed into another rate cut. It may actually push that out into the future. And the inflation hawks are going to go, look, we're seeing evidence now that prices are accumulating and the pace of growth is increasing, and we probably shouldn't cut interest rates.
And this all coming as we just saw celebration of mortgage rates reaching below 6% for the first time we've seen in a few years. Sarah, let's take a quick break. We'll be we'll come right back here in a few minutes with more on the economic impact of this conflict between the U.S. and Iran.